Hi guys, this is our econ group assignment. So where this group assignment is about exchange rate analysis, and our business we chose to do is Qantas. I'm Sharple, and let me start you off by introducing Qantas to you guys. Next slide. So Qantas Air Group, right? Qantas operates through two main airline branches, Qantas and which is the premium service carrier, and Jetstar, the lower cost alternative. Together, they provide excellent domestic and international passenger transport, regional services, and significant cargo operation, with major hubs in Sydney that routes spanning Australia and globally. Qantas maintains a strong and reliable flight network, which helps lower the economical risks. The airline also strengthens its global reach through the One World Alliance. The strategical share code partnership allows customers to seamlessly connect through hundreds of destinations worldwide. So nextly, let's talk about the products and service Qantas offers us. Qantas offers a wide range of products and services designed to meet the need of diversified travelers. Its core service is air travel, available in business, premium, economical, and other classes. Across, across domestic and international, beyond passenger transport, Qantas provides cargo services. It has a loyalty leading program through and gives you access to um, premium airport lounges, which lowers the chance of transactional exposures. The airline may also offer travel-related services such as holiday package and partnership rewards. Next slide. Okay, so the source of revenue for Qantas. Um, so Qantas generates revenue through multiple sources of income. They strengthen its financial stability. The largest share comes from its ticket sales across domestic and international flights, with revenue varying by class, routes, and fare structure. Additional Additional income comes through baggage fees, in-flight meals, seat upgrades, and exclusive onboard experiences. The Qantas loyalty is another major contribution, generating recurring revenue through its rewarded seats, partnerships, member fees. Qantas also owns cargo and freight operating along with its alongside partnerships code sharing agreement, which expands globally, reaching and delivering income and diversifying income. Together, these streams create a balanced and a sustainable revenue model. So next is Qantas's operational costs. Qantas manages a wide range of operational costs that are essential to maintaining a high service standard. Measure Most of its expenses include fuel, aircraft maintenance, staff wages, airport fees, and in-carry catering. The airline continues to invest modern, fuel-efficient aircrafts and fuel reduction, which we'll go further on in this presentation. Um, Additionally, Qantas remains committed to sustain a fleet of transformations, aiming to improve efficiency, reducing emission. These are its ongoing investments, ensuring Qantas maintains competitive and innovative and well positioned for a sustainable advancing future. Now on to Harry, who's going to talk about ER risks.
Hello, I'm Harrison Fennick, and I'll talk about three types of exchange rate risk and how it relates to Qantas. Three types of exchange rate risk is transaction exposure, which deals with future cash flows and their contractual obligations, economic exposure, which just deals with how future cash flows are related to currency fluctuations, and translation exposure, which is the requirement to translate foreign operations into domestic currency. So for transaction exposure, it typically deals with the outflows rather than the inflows for Qantas. The reason being is because consumers purchase flights in advance, and thus Qantas does not experience any transaction exposure. The outflows, however, will experience lots of transaction exposure. This is because fuel is typically a cost made in advance, in addition to it being primarily in US dollars as the industry standard. The main way which Qantas manages this is via fuel hedging, the industry standard, where it's essentially a derivative directly on fuel itself. Other various small costs can be naturally hedged, especially those regional costs such as airport dues, etc. For economic exposure, it deals with both the inflows and the outflows for Qantas. The inflows it deals with international competitiveness. This doesn't affect the number of flights itself, but it does affect the destinations. Qantas tries to manage this via geographic diversification by setting up multiple flights across multiple countries and operating in multiple countries. This is quite useful to go and mitigate this. However, as Qantas primarily operates in Australia, it is not as diverse as possible. In addition, the outflows, which economic exposure does affect, is typically the fuel costs over a longer term. This is because as fuel is primarily in US dollars, an appreciation of US dollars typically will lead to a higher operating cost over the long term, all else equal. And other specific costs can be hedged via can be naturally hedged. For translation exposure, this deals with the requirement which government regulators and shareholders require via accounting metrics to be in a singular currency, which is the Australian dollars. This does impact, for example, net revenue, debts to assets, quick ratio, etc. Uh, the reason why the reason why this is important is because Qantas has an obligation to inform shareholders about their performance so that shareholders can make an informed investment decision, which will include its foreign operations, as it will go and correctly identify their net revenue, debts to assets, etc. Government regulators would require it for both taxation-based purposes, and it does also serve a function in some form of liquidity requirements. The way which Qantas manages this is via derivative hedges. Specifically, they mention collared options being a key part of their strategy.
Hi, my name's Dane, and I will be looking into the hedging strategies of Qantas. So, the international nature of aviation means that airlines are heavily exposed to foreign exchange fluctuations. Most carriers earn revenue and pay expenses in multiple currencies, and converting these cash flows exposes them to currency risk. This chart here this is from the Bank for International Settlements, and they show while over two-thirds of annual currency movements between 1994 have stayed within a plus or minus 6% range, periods of greater volatility still occur, and for airlines with global operations, these swings can have major financial impacts. So here we can see how the foreign exchange fluctuations can directly impact the consumer decisions, the airline decisions, as well as the financial accounts, as well as the indirect impacts between the three. The US dollar is particularly important since major costs like fuel, aircraft purchases, and maintenance, and around 40% of total operating costs are all priced in US dollars, according to the International Air Transport Association. This same association, they say that fuel accounts for about one-third of airline expenditures, which we can see here, making it a key focus for Qantas's risk management strategy. And we can see here that looking at Qantas's annual report, fuel costs make up approximately a quarter of total expenditures for Qantas for both the 2024 and 2025 financial year. So to manage both these fuel and foreign exchange volatility, Qantas operates a comprehensive hedging program using a mix of forward contracts, currency options, and swaps. Fuel prices are volatile, which Qantas attribute to the Middle East conflicts and tensions, as well as global supply uncertainty. So to reduce risk, Qantas uses fuel derivative collars, options, as well as swaps on jet kerosene, gas oil, and crude oil. So specifically, a collar strategy, which involves buying a put option and selling a call, limits both the losses and gains, helping Qantas stabilize its fuel costs and plan ahead more confidently. So we can look at Qantas's annual report in 2025 again to see the impact of this activity. We can see in 2024 they had a net derivative position of 220 million, and in 2025 that net position was 77 million. And we can see the breakdown between the assets and the liabilities. But this table here breaks that down further, and we can see specifically what they're hedging against. We can see Australian dollar fuel costs here up to 2 years are hedged, 26 million barrels of crude oil. And we can see that that's a net positive asset position, which makes sense considering that oil is a cash outflow for Qantas. This 26 million barrels of jet fuel is actually quite significant, considering that in the financial years 2020, 2021, and 2022, their average fuel consumption was approximately 15 million barrels of oil. While we don't have the latest consumption data, we can assume that that would be a lot higher considering that the demand has increased coming out of COVID. But still, this 26 million barrels of oil being hedged is quite significant. We can see in also the revenue being hedged, and we can see that this is a net liability, which makes sense because it's protecting against a cash flow, Qantas's cash inflow. And we can see revenues of 402 million US dollars as well as 47 million Japanese yen are being hedged against. And we can also see their respective rates here. So in addition to these revenues, Qantas says it uses forward foreign exchange contracts and currency options to hedge part of its foreign currency exposure to aircraft purchases, maintenance contracts, as well as capital expenditures, which we can see here. This can also be typically hedged up to 2 years. And in 2025, the group reported 15 million in net derivative assets related to capital expenditure hedges, which we can see in this last row here. So together, fuel and currency hedging gives Qantas greater cost predictability and operational flexibility, allowing to adjust its capacity and pricing in response to market changes. However, it's worth noting that hedging is a double-edged sword. As journal notes, when fuel prices fall, airlines with locked-in hedge contracts may end up paying more than unhedged competitors, showing that hedging can sometimes hurt short-term profitability. But overall, Qantas' approach demonstrates a disciplined and diversified hedging strategy, balancing options, swaps, forwards to manage its largest variable costs. While derivative values fell in the 2025, the program continues to give Qantas stability, flexibility, and protection against unpredictable market movements in both fuel as well as foreign exchange. Thank you.
Hi, my name is Alexander Della, and I will be going through the natural hedging strategies of Qantas. Natural hedging strategies or operational hedging strategies are simply the things that an MNC does in its day-to-day operations that reduce its potential risk or exposure to foreign exchange fluctuations. The three main ones employed by Qantas are geographic diversification, fuel-efficient investment, and revenue expenditure and matching. The leading and lagging payments is something that we will discuss. Qantas likely already does this, but I couldn't find anything suggesting that it did, so it's something that it should be taken into account if it does not do so already. Geographic diversification. Geographic diversification is simply the currency spread that an MNC has by virtue of its operations in the international marketplace. So Qantas flies to 60 regional destinations, has flights to all Australian capital cities, and flights to all continents except Antarctica. Now, the scope of its international operations therefore means that it has quite a diverse portfolio of currencies that it has accepted as payments for its services. As a result of this, its international currency portfolio, being quite diverse and quite spread, is at the lowest or close to the lowest limit of risk in the foreign exchange marketplace. If one currency were to appreciate, another should depreciate, and overall the bundle of currencies should minimize any effects that an appreciation or depreciation of any singular currency should have. Moving on to fuel efficient investment, Qantas has recently undergone a fleet renewal. It has taken on 2 new A321XLRs, 1 new Dreamliner, 5 A321LRs, as well as 2 A320neos. It has also taken on 2 new Boeing 737 MAX 9s and is expected to commence Project Sunrise in 2027 when it receives its A350 1000 ULRs. The thing that all these aircraft have in common is that they're more fuel efficient than their predecessors. Now, by making sure that their aircraft are more fuel efficient, Qantas places less reliance on fuel and is therefore less exposed to fuel price volatility. So through fleet renewal and capital expenditure of this nature, Qantas is naturally hedging against fuel price volatility in the future, particularly given the Middle East conflict as well as Russia-Ukrainian war, which has spiked fuel prices recently. All the new aircraft have been listed in their financial year 2024 report. Thirdly, matching revenues and expenditures. It is important to match revenue and expenditures because if you have a pool of revenue already in one currency that your expenditures are mainly in, you don't have to risk foreign exchange movements in transferring currency across. So Qantas has its major costs in USD and also has high liquidity in the US dollar because of its operations in the US. Its major costs in USD are wet aircraft leases, fuel costs, and other capital expenditure commitments. These are all listed in its financial year 2024 report. Its other capital expenditure commitments include maintenance and the actual outright purchase of new Boeing aircraft. All these costs are in USD. As I said, Qantas has quite a high liquidity in the US dollar, so it is minimizing its foreign exchange risk by not having to change from AUD to USD to make sure that these operations can occur. Finally, leading and lagging payments. Now, this hasn't shown up in its financial reporting. This is more just a timing of payments thing. So it wouldn't necessarily show up in its financial reporting. But simply leading and lagging payments, if your currency is forecast to depreciate, pay early, get the maximum benefit of the dollar while it's still valued quite high. Conversely, if your dollar is expected to appreciate and get more valuable, you pay as late as possible so that you can get the full value of that dollar later on, and as a result, you're taking a bit out of, you're maximizing the benefit that you get out of each of those dollars. Qantas, as an MNC, is likely already doing this. It hasn't stated it specifically in its financial reporting that it does do this. If it doesn't, it needs to get onto it quick smart. But that is the extent of its operational hedging strategies. So, as I said, leading and lagging payments, matching revenues and expenditures, fuel-efficient investment, as well as geographical diversification.
So in terms of the actual effectiveness of hedging for Qantas for exchange rate volatility, as we mentioned, there can be significant periods of more than 6% changes in exchange rates, which we have seen. And while most of it is within this -6 plus 6% range, because a company like Qantas has so much expenses in US dollars and so much revenues coming in from US dollars and Japanese yen, and they have just so much financial exposure, it's quite important for them to hedge. But obviously, by doing that, and if they have a very aggressive hedging style, they can miss out on favorable movements, as we've seen before, especially in fuel hedging. The huge drop in 2014 for Brent crude oil was very good for a lot of airlines, but if you were super hedged against that, you'd miss out on that. And we saw that. We saw that Virgin Australia's derivative position had a $209 million loss in 2016, which was around here. And so did Delta in America, who had a $4 billion loss. And now, while that was for specifically commodity hedging, we can see how that could happen with exchange rate hedging as well, because considering that Brent oil is in US dollars, all of these movements, if you're not hedged against, hedging is not free. So if Qantas has a huge hedging position, they're having to pay a lot of fees if there's unfavorable collateral obligations, and those can change over time. It can be quite difficult for Qantas to compete with a lot of airlines, especially if they're getting favorable movements in the market. So given these limitations, I think a broader risk management approach that incorporates operational hedging may offer a much more resilient alternative. Strategies such as fuel-efficient aircraft, reducing fleet age, enhancing fleet commonality, can lower fuel consumption and operating costs and lower this exchange rate volatility. And I think that can provide a more effective risk management framework. Thank you very much.